You look at the screen and see red, and your gut reaction, the instinct you've been trained to have over years of watching these charts, is that something broke. You see silver down $26 in 48 hours. You see it flushing to 95, and the immediate assumption is that the demand just evaporated, that the story is over, that the Fed hawk or the dollar spike or whatever the headline is this morning finally killed the momentum. But then you look a little closer at the plumbing, away from the flashing numbers on the COMEX, and you see something that, well, it just doesn't fit. It's the kind of anomaly that usually gets buried because it's complicated or because it doesn't fit the panic narrative, but it's actually the only thing that matters right now. It's quiet, almost too quiet given the violence of the price move. Because while everyone is obsessing over the paper price flushing, nobody is talking about the gate that just slammed shut on the other side of the world. It happened on January 1st effectively, but we're only seeing the real consequence of it now, in this exact moment of weakness. It's not a tariff, it's not a tax, it's a list of 44 names. Before this year, if you were a trader in Shanghai and you saw an arbitrage window, if silver was expensive in London and cheap in China or vice versa, you moved the metal. You balanced the world. That's how efficient markets work. But as of 4 weeks ago, that mechanism is gone. It's been replaced by a wall. They're calling it the silver curtain, though you won't hear that on cable news updates because it sounds too dramatic. But frankly, the reality is more dramatic than the name. We are looking at a situation where the largest refining hub in the world, the place that processes the vast majority of the silver that eventually ends up in your electronics, your solar panels, and yes, your vaults, has essentially nationalized its supply chain without technically banning a single ounce. So you have this massive disconnect. On one hand, you have a paper market in New York screaming that nobody wants silver, that it's time to sell, that the liquidity is drying up, and on the other hand, you have a physical market in the East that has completely detached, where the metal is trapped and the premiums are screaming that there isn't enough to go around. The price says 95. The plumbing says something else entirely. And that's the trap. The trap isn't that the price is falling. The trap is thinking that the price on your screen is the price you can actually pay to get the metal. See, usually when we get a flush like this, a 17% drop in 2 days, it flushes out the weak hands. The leverage gets wiped and we reset. Standard operating procedure. I've seen it a dozen times. But this time, the flush is happening against a backdrop of a supply chain that is fundamentally broken in a way we haven't seen in decades, maybe ever. We need to talk about what actually happened on January 1st with that licensing regime. We need to talk about why those 44 names on the whitelist matter more than the Fed chair nomination. And we need to look at why this $95 handle might be the most dangerous number I've seen on a chart in a long time. Not because it's a floor, but because it's a mirage. It's uncomfortable to look at a crash and say, this is bullish, and I'm not going to sit here and tell you to buy the dip just because it's down. That's reckless. What I want to do is show you the mechanism that is currently grinding gears beneath the surface, because if you miss this, if you treat this like just another volatility spike, you're going to miss the signal that actually counts. Let's walk through the plumbing. So let's look at who is actually bleeding here, because if you just glance at your portfolio, it feels like you are. It feels like anyone holding metal is taking the hit. But that's the surface level pain. That's the psychological pressure of seeing a number flush red. If you peel that back and look at the actual structure of the market right now, the entity that is really exposed isn't the guy holding coins in a safe, and that isn't the industrial end user who needs the stuff to build panels. The exposure has shifted entirely to the arbitrage desks, the people whose entire business model relies on the idea that silver can move freely from point A to point B. For the last 20 years, that was a safe bet. If the price in London got too high, metal flowed from Shanghai. If New York got too cheap, metal flowed out. It was a giant sloshing bathtub, and the water level always eventually evened out. But on January 1st, China put a divider right in the middle of that bathtub.
Most people miss this because it was buried in administrative bureaucracy. The Ministry of Commerce didn't come out and say, "We are banning silver exports." That would have started a trade war instantly. Instead, they did something smarter and much more effective. They switched from a quota system, which is just about how much you can ship, to a whitelist system based on dual-use security clearance.
That phrase, dual use, is doing a lot of heavy lifting. Back in October of 25, we saw the first hints of this when Beijing reclassified silver alongside things like tungsten and antimony. They stopped calling it a commodity and started treating it like a strategic asset for national defense and technology. And then came the list, 44 names. That is the total number of entities now authorized to export silver from the world's largest refining hub. And when you look at who is on that list, it's not the scrappy independent traders who grease the wheels of the global market. It's state-linked giants. It's Jiangxi Copper. It's Yunnan Tin. These are companies that don't move metal because there's a 50-cent profit to be made on a spread. They move metal when the state tells them it's in the national interest to move it. So here is the contradiction that is driving me crazy this weekend. We have silver crashing to $95 in the West. In a normal market, low prices cure low prices, right? But look at the Shanghai Gold Exchange. While COMEX is flushing, silver in Shanghai is trading at an equivalent of roughly $112. Think about that math for a second. There's a $17 gap, a $17 premium sitting right there. In 2024 or 2025, that gap would have closed in an afternoon. Traders would have bought every ounce they could find in New York or London, put it on a plane, and sold it in Shanghai until the prices matched. But today, that gap is sitting there wide open. It's not closing. That tells you everything you need to know about the silver curtain. It tells you that the arbitrage mechanism is broken. The metal cannot flow to capture that profit because the people who usually move it didn't make the list. They didn't have the 80-ton annual capacity or the $30 million credit lines required to get a license. So the West is now an island. We are flushing the paper price down, but we are doing it in isolation. They know that if those 44 Chinese exporters don't start shipping soon, the COMEX warehouses are going to get drained by industrial users who are desperate for physical delivery. The banks don't want to be short a contract when there is no metal to deliver because it's all stuck behind a bureaucratic wall in Shanghai. This is the dual-use trap. By labeling silver a strategic asset, Beijing has essentially told its state-owned enterprises, the companies on that list, that their primary job is not to make a profit in dollars. Their primary job is to ensure China's industrial dominance in the next generation of tech. Think about the solar targets we just saw released, 665 gigawatts. That is an obscene amount of energy infrastructure, and every single panel requires silver paste. If you are running the Chinese economy and you know you need 125 million ounces of silver just to meet your energy goals this year, are you going to let your refiners export it to London just because the arbitrage window is open? No, you keep it. You let the West starve for metal while you build your grid. This turns the silver market from a financial casino into a geopolitical resource war. And in a resource war, the paper price is often the last thing to move, right before it snaps. Now, I want to pause here for a second and be completely honest with you. I need to give you the counterargument, because if I don't, I'm just selling you a story. There is a scenario where I am wrong about this. What would invalidate this entire thesis? Two things. First, if we see the February export data, which comes out in a few weeks, show a massive surge in volume despite the licensing, it is possible, theoretically, that this whole whitelist thing is just a paperwork formality. Maybe the Chinese government approves every application instantly, the metal flows out, the arbitrage gap closes back to zero, and the Shanghai Premium collapses back to zero. If we see millions of ounces hitting the LME warehouses next month stamped with Chinese refinery marks, then the silver current is a nothing burger. It was just a scare tactic. The second thing that would kill this thesis is a global recession so severe that industrial demand falls off a cliff. If the US and Europe go into a hard landing in Q2 and factory orders stop and nobody is buying electronics or installing solar roofs because they're broke, then the supply constraints don't matter. It doesn't matter if you can't get metal if nobody wants it.
In that scenario, silver goes down with everything else, supply shock or not. I'm watching the manufacturing PMIs like a hawk for this reason. If they crack, the bullish case gets much harder to hold in the short term. But, and this is a big but, we aren't seeing that yet. The data we have today shows the opposite. We see sticky inflation, we see robust industrial orders in the energy sector, and we see the Shanghai Premium holding at record highs. So, assuming the world doesn't end tomorrow, we're left with a binary path forward. Path 1. The paper cap holds. The West continues to trade silver as a currency derivative, selling it down every time the dollar strengthens. In this scenario, the price stays suppressed in the $90 to $100 range, but the consequence of this is that the physical metal continues to drain. The arbitrage stays open. Asia continues to buy everything that isn't bolted down. Eventually, the COMEX registered inventory hits zero, or effective zero, and the exchange has to change the rules. They'll force cash settlement. They'll say, sorry, we can't give you the bar, here's a check. That is a default in all but name. It's the end of the current pricing mechanism. Path 2, the repricing happens. The Western markets wake up to the fact that they can't source metal at $95 anymore. The price rallies aggressively to close the gap with Shanghai. We see silver rip through 110, 120 purely to stop the bleeding of physical inventory. This is the violent snapback. It's not a slow grind, it's a gap up because the sellers simply vanish. This is the binary setup. We are either heading for a delivery failure or a massive price correction to the upside. There is no middle ground where we just drift sideways at $95 for a year. The math of the physical flow doesn't allow it. You can't have a 10% global deficit and the closed supply valve and stable low prices all at the same time. Something has to break. And looking at the way the dealers are acting right now, raising premiums on coins and bars even as the spot price falls, it looks like the physical market is already voting for Path 2. They are pricing in the scarcity that the futures market is ignoring. You're seeing spread divergence that we haven't seen since 2020. Back then, it was a logistics issue. Planes weren't flying. Today, it's a structural issue. Planes are flying, but the metal isn't on them. This brings us to the climax of what this actually means for how you position yourself. Because recognizing the problem is only half the battle. You have to know what to do when the rules of the game are changing in real time. If the paper price is losing its authority, then the tools you use to track value have to change. You can't just watch the ticker anymore. You have to watch the spreads. You have to watch the warehouse reports. And most importantly, you have to watch the political rhetoric coming out of Beijing, because that is where the real price discovery is happening. We're moving into a phase where holding the asset is not enough. You have to understand the liquidity risk of the asset itself. If you hold paper silver, you're holding a promise. If you hold physical, you're holding the collateral that the promise is based on. And right now, there are a lot more promises than there is collateral. So how do we play this without getting burned by the volatility? Because if you lever up now thinking it has to go up tomorrow, you could get wiped out by one more margin call flush before the real move happens. Here is the playbook I'm building for this specific silver curtain environment. The first rule of this playbook is uncomfortably simple. Survival takes precedence over maximization. When you're dealing with a market that's fracturing, where the East is trading one reality and the West is trading another, the volatility isn't just noise, it's a weapon. A 17% drop in 48 hours, like we just saw, is designed to do one thing: clean out the leverage. If you were long futures contracts with 10x leverage on Thursday thinking the breakout was inevitable, you're gone today. The market took your position and now it's going to take the ride without you. So my personal strategy right now is purely unleveraged. I am not trying to time the bottom of this $95 flush with options that expire in 2 weeks. That is a fool's game when the pricing mechanism is broken. And this is where it gets dangerous for anyone who is shorting this market thinking the momentum is real. You're shorting a market that has lost its supply valve. I was looking at the inventory data from the Shanghai Exchange this morning, and this is the number that really stops you in your tracks. 531 tons. That's it. That is what is sitting in the registered warehouses in Shanghai right now. It's a 10-year low. Now, normally, when inventories get that low, the price rips higher to attract metal. And in China, the price is staying high relative to us. But because of this export lock, that signal isn't traveling to New York. The signal is being jammed. So you have this bizarre reality where Western algorithms are trading based on the DXY spiking or the Fed nominee, completely ignoring the fact that the physical cupboard in the East is bare and the door to restock it is locked from the inside. This is where people get trapped. They see the price drop and they think, oh, demand must be weak. No. Demand isn't weak. The market is fragmented. You are looking at a localized paper liquidation in the West, while the East is effectively hoarding. And I use that word hoarding carefully. I don't mean it in the conspiracy theorist sense. I mean it in the industrial sense. If you are a Chinese solar manufacturer, and remember, they are looking at building over 600 gigawatts of capacity this year, and you see the government restricting exports, what do? Do you sell your inventory because the price is high? Absolutely not. You grab every ounce you can find because you know that if you run out, you can't just import it easily anymore. The export ban implies an import anxiety. It signals that the state is worried about keeping enough metal inside the country. So while we are panicking over a $20 drop, the smart money in the East is looking at this as a gift. They're likely draining that Shanghai inventory even further as we speak. There's another layer to this exposure that isn't being priced in yet, and it has to do with the refining choke point. We talk a lot about mining, about Mexico, about Peru, but mining is just rocks in the ground. It doesn't matter if you have ore if you can't turn it into 0.999 fine bars. A huge percentage of the world's silver flows through Chinese refineries. Even silver mined elsewhere often ends up there for processing. If that metal goes in, but the new license regime says it can't come out without a state-level stamp of approval, then the West has a much smaller pool of refined metal to draw from than the charts suggest. This is why I say the price is a mirage. The spot price is supposed to represent the global clearing price for silver. But right now, there is no global clearing price. There is a Western price and there is an Eastern price, and the bridge between them has been burned. If you are selling down here at 95 because you think the trend is broken, you're essentially betting that the East will suddenly decide to open the floodgates and dump metal into a falling market. Why would they do that? Why would a state-linked entity in China use its precious export quota to sell silver to the West at a $17 discount? They wouldn't. So the supply that usually caps a rally, it's not coming. And the supply that usually buffers a crash, it's not coming either. We are on our own. And that brings us to the most uncomfortable part of this setup. If the physical metal is stuck in the East and the paper market in the West is selling off, who is buying the physical metal that is here? Because the vaults in London and New York aren't infinite. We saw withdrawals pick up last week, massive ones. 33 million ounces left COMEX. And that wasn't a coincidence. That was the smart money realizing that if the East is closed, the only place left to get metal is here, and they're taking it now while the price is down. This is a dynamic that flips the narrative upside down. The lower the price goes on the screen, the faster the physical inventory drains from the West, because it's the only open window left. But there's a mechanism underneath this, a specific way the licensing rules interact with the solar demand that makes this even tighter than it looks. It's a detail most analysts gloss over because it's boring supply chain stuff, but it's actually the fuse on the powder keg. The mechanism I'm talking about is something called processing capacity leverage, and it's the single biggest blind spot in Western market analysis right now. See, we tend to obsess over mining numbers. We look at a map, see that Mexico is number 1 producer, see Peru is number 2, and we tell ourselves, well, China only digs up about 12% of the world's silver, so if they lock the doors, it's painful but manageable. That is a fatal simplification. It's like saying Saudi Arabia only pumps oil, so who cares who refines the gasoline? The reality is that China dominates the processing step. A massive amount of the silver mined in South America, in Africa, even in parts of Asia, gets shipped as raw concentrate, essentially dirt with metal in it, to Chinese smelters. They have the capacity, they have the technology, and for years they had the lowest environmental compliance costs. The world outsourced the dirty work of refining to them. So when that silver comes out the other side as 99.9 fine bars, it is technically Chinese silver, subject to Chinese export rules. This is the lever they just pulled. By restricting the export of refined silver through this licensing list, they haven't just trapped their own domestic mining supply, they have effectively captured a huge chunk of the global refining run rate. If you are a battery maker in Korea or a solar plant in Germany, you don't buy silver ore, you need the refined product. And if the world's biggest refiner says, sorry, our 44 licensed exporters are busy prioritizing domestic stockpiles, where do you go? You can't just spin up a smelter in Texas overnight. It takes years to permit and build that infrastructure. This creates a structural bottleneck that has nothing to do with the price of the metal. You could take silver to $200 tomorrow, and it wouldn't magically create more refining capacity in the West. And this brings us to the behavior of the market participants right now, which is frankly baffling unless you understand this bottleneck. We are seeing the commercial shorts, the big banks, covering their positions aggressively on this dip. You'd expect them to be adding shorts if they really believe the price was going to zero, right? But the open interest data suggests they are using this flush to get out. Why? Because they know the physical delivery risk is rising. I am looking at position sizing that allows me to sleep if silver drops another $10, because the paper price can do anything in the short term. It can go to 80 if the algo trading bots decide the dollar strength is the only variable that matters. But here is where the scenario tree splits, and this is how you need to think about the next 30 to 60 days. Scenario A is what I call the deflationary drag. The Fed hawk narrative takes over. Yields spike to 4.5%, and everything sells off. Stocks, crypto, metals. In this world, silver spot prices could grind lower. But, and this is the critical silver curtain variable, watch the premiums. In a deflationary crash where production is also constrained, remember, miners go bust in this scenario too. The physical premium on the street will explode. We might see spot at $85, but you won't be able to buy an eagle or a bar for less than $110. We saw this in 2008 and 2020. The paper price becomes a fiction. If we enter this scenario, I am not selling. I am ignoring the screen price and watching the dealer sold out signs. That is the real market. Scenario B is the industrial panic. This is the one the shorts are ignoring. This happens if a major industrial user, a Samsung, a Tesla, a massive solar conglomerate, decides they can't risk the delivery delays anymore. They stop trusting the COMEX to deliver and they go direct to the mines. They sign offtake agreements that bypass the exchanges entirely. If this happens, we will see the registered inventory on COMEX vanish overnight, not because of traders, but because of corporate procurement. This is the match that lights the powder keg. If one major player panics, they all panic. Inventory creates its own gravity. So, what am I watching to know which path we are on? I have 3 specific indicators on my dashboard, and I'm tuning out everything else. First, I am watching that Shanghai Premium like a hawk every single morning. If that gap narrows, if the Shanghai price drops to meet New York, then my thesis is weakening. It means supply is finding a way through the curtain or Chinese demand is softening. But if that gap widens, if we see it go to $20, that is the pressure cooker building steam. That tells me the arbitrage is completely dead and a repricing is mathematically guaranteed. Second, I am watching the eligible to register transfer numbers on the COMEX. I don't care about the headline inventory number as much as I care about the movement. When metal moves from eligible, private storage, to registered, available for delivery, it means someone is willing to sell at these prices. If that movement stops, if nobody is willing to move their metal into the deliverable pile at $95, then the exchange is effectively dry. We are seeing signs of this now. The owners of the metal are saying, no thanks, I'll keep it. Third, and this is the behavioral check, I'm watching the delivery volume relative to open interest. Usually less than 1% of contracts stand for delivery. Last month, it ticked up. If we see that jump to 2 or 3% in this February contract window, the game changes. The fractional reserve system of paper silver cannot handle a 3% delivery rate. It breaks at 5. We are creeping closer to that danger zone every month the silver curtain stays up. Here is what I am explicitly not doing. I am not shorting the dollar to play the silver bounce. That's a correlation trade that used to work, but it's broken right now. The dollar can go up and silver can go up if the driver is physical scarcity. We've seen gold do exactly this, hitting all-time highs while the dollar was strong. Silver is next. The dollar up, metals down algorithm is a legacy code that is about to be rewritten by physical reality. And I am not listening to the demand destruction narrative until I see it in the solar data. Analysts love to say, oh, at $100, solar companies will use copper. No, they won't. Not this year. The retooling takes years. The efficiency loss is too high. For the next 24 months, the solar industry is a hostage to the silver market. They have to pay the price. So where does this leave us? It leaves us in a window of extreme dislocation, a window where the price you see is not the value you get, a window where a bureaucratic change in Beijing has done more to alter the supply-demand balance than a decade of Fed policy. We're sitting at the bottom of a flush, staring at a locked supply chain, watching the inventory drain away.
I know it feels terrible to look at the portfolio today. I know the red numbers induce panic, but you have to ask yourself, if the metal is so worthless, why is China locking it inside their borders? If the price is going to zero, why is the smart money taking delivery of 33 million ounces in a week? The trap isn't the price drop. The trap is handing over your physical position to an entity that knows the silver curtain is real, while you are still staring at a chart that thinks it's 2019. Don't fall for the liquidity flush. Watch the plumbing. So here's a question you need to answer for yourself before the markets open on Monday. Do you believe the Shanghai Premium is a glitch that will fix itself? Or do you believe it's the new reality of a bifurcated world? Because you can't have it both ways. Either the arbitrage opens and silver floods back west, or the west has to reprice higher to stop the drain. I know where I'm placing my bet. I'm betting on the physical wall. In the next update, I'm going to pull the specific loadout reports from the outcome of this February delivery cycle. We're going to see exactly which banks took the metal from the STIP, and more importantly, which vaults it went into. The names might surprise you. Keep your head on a swivel. It's going to be a volatile week.